Hello, me. This is a trade review to learn from what happened on Friday. And this is part of documenting my journey and continuing to develop as a trader. And for those of you that are listening, I hope you benefit from this video as much as I hope I will benefit from it. So, this is a trade review for Friday, October 17, NQ December contract. And as you can see here, before I put on any lipstick on the chart, as you can see, we're still trading inside the last Friday range. We still couldn't break out of it lower or higher. When that happens, this is called a range bound environment, or a range bound week, right? So when we are or an inside week, right? We can call it also an inside week. So that is to say, when we are trading inside like a candle, right? And we're unable to break out of it, right? We are unable to broke through that candle's high or break through that candle's low. So we're still trading inside this range. So let me show you the weekly chart to see it more clearly. So you can see throughout the whole week we couldn't break out of last Friday's candle, right? And we're still trading inside of it. And but it's when you're in this environment, it's very difficult to know whether we are going to break higher or lower. So I guess we will have to wait for Sunday's open to have more information to determine that. So this is the environment we are trading in right now. Some of the things that are worthy of note on a daily chart before we go into the lower time frames. So as you can see here, on Friday, before the pre-New York session, we came all the way down and we took, what is this? This is Tuesday 14 low. So we took that low, right? We took the sell side liquidity that was resting in there before we moved any higher. So this was a manipulative move, right? Because, with everything that is going with the US and China, the tariffs, and everything that is going with the economy right now, people are thinking that we are going to crash. We're going to enter a bearish environment after we have been making all-time highs, over and over again. So the idea that we will make another all-time high for a lot of people is not on the table, right? So when a lot of people, when they see this move down, right, all this expansion we took, like on Friday, we took Thursday's low, and we take Tuesday's low, right? So Friday formed the low of the week, right? And when people see that, they tend to go short because they believe that we are going to just continue going higher and break below this low. Maybe it's going to happen. We don't know. But you see how smart money is playing on that idea by manipulating people into going short because they think we are going to be bearish, and they reverse price and they go higher again, right? And they catch traders on the wrong side of the market, right? So that's what happened on Friday 17, we came all the way down, took Thursday's low and Tuesday's low, right? And we came all the way back here, and that's what we are at for now. We will wait for next week to know what happens. So a lot of people are also have the idea that since we opened the limit up on Monday and we didn't completely fill the new week opening gap, that next week we're going to do so. And this may be like this idea may be used by smart money, you know, to catch people on the wrong side again. So you might want to be mindful of that unless price action, right, presented that idea, and unless there are signatures in price action that shows we're going to fill that new week opening gap, because it's a gap is going to be filled, right, eventually, but it's not going to happen in a couple of days or 1 week. It can take many, many weeks before it's finally filled, right? So don't expect that, well, it's obvious that we're just gonna go and fill that gap. It may happen, it may not happen. We have to wait for price action to kind of show its hand and tells us where it is likely to go. So our style of trading is it has to be based on reading price action and what price is doing at the moment and react to it. We're not trying to predict what is going to happen for next week or next 2 weeks, etc. Nobody can do that. We can have assumptions, yes, but they can be wrong as much as they can be right. So we always have to be reactive in the way we trade, and we have to rely on what price is trying to show us, right? So with that said, let's drop down into the lower time frames, right, and see what happened in detail on Friday. Let me drop down to, I don't want to make this very long, so I will drop immediately to the 1 minute chart, because I want to discuss like an idea that I noticed, and you guys can tell me what you think about it. So let me put some lipstick here, and just to show what happened. So our trading day rather, began on this. Let me zoom that out. So our trading day for Friday began here. So after the New York afternoon session finished, we opened at 6 p.m. on Thursday, and we traded into this buy side liquidity, and look how we reacted off that, right? Look how we did that. And then we retraced all the way here, and we took this sell side liquidity, right? And then we reacted off that, and we came all the way back again, and we took this short-term high, and the buy side liquidity rested in here, and then we went back down. Then we did the same here, and we did the same thing here. We took this sell side liquidity and resumed going lower. We did the same thing here, right? And I have been tracking to see how price reacts once it hits a short-term high or low. So you can see here. Let me just zoom this part a little bit so you can understand what I'm talking about. So this is where this line, basically this one, I will try to maybe make it bold so that it stands out. This is the Tuesday's low that we talked about, right? This is the Tuesday's low that we talked about. This is the new week opening gap, and the upper quadrant, midpoint, lower quadrant, and the low of that new week opening gap, right? So you can see how we came down into the lower quadrant, upper quadrant, and they reacted off that, and we took the liquidity that was resting in that Tuesday's high. So I'll zoom in just for you to see. And look at how we beautifully reacted off that. We came to it, triggered the sell side liquidity that was resting in there, and we immediately start to rally, right? So I want you to think about what I have delineated here in blue, right? How price, and I said that before, and like from my own observation and experience, and also from watching and learning so much content of ICT, and you know how he can be very, very long-winded, and his lectures can go into, I think the longest one that I've watched, it lasts for about 5 hours, right? And he can be very, very long and can be very confusing to understand, and his content basically is massive. You kind of like lose yourself drowning in that content. But one of the things that I learned from him, and I tested it for myself, and I can see its validity, is how price, the algo, the market, whatever you want to call it, moves, right, to hunt liquidity, right? Move to harvest liquidity. And where do people normally, like retail traders, right, or individual traders that don't have huge capital to have very big stop losses, basically, right? Especially if they're scalping, trading on the lower time frames. I mean, if you're trading on the lower time frames and you're a scalper and you have a short capital, you cannot extend your stop loss, very wide, because otherwise you're increasing the risk. And if the market moves against you, you are in danger, right? So usually people, when they're scalping, they place their shorts above short-term highs or lows, right? Like in here, for example, right? And there are people who are trading with ideas of support and resistance. So when they see this, they think it's like resistance, right? And this price is going to go lower. So if they think this is resistance and price is going to go lower, where are they going to place their stop loss? Somewhere around here. And you can see how the market goes all the way down, and if you got out here, with support and resistance, you can be profitable, and assuming you're aware of how the price moves to harvest liquidity, but you can see how it made people feel safe, make them feel that they're right in their analysis, and it reverses against them and takes their stop here, right? And so I want you to see over, we can start from here. You can see how when we tagged into that Tuesday 14 low, you can see how we reversed immediately, and then we came, tapped it here, right? And then we came all the way here, and we took this short-term high, and then we retraced, right? Then we took this short-term high, then we retraced, and then we took this short-term high, then we retraced, then we did the same here, retrace, right? Short-term high, retrace, right? Short-term high, retrace, and this is the liquidity that was basically here, right? This is what I have here delineated, right? Retrace, right? You can see it here as well, right? Come back here, take the sell side liquidity, orders, resting above here, retrace. Take it here, retrace. Take it here, retrace, right? And then continue higher. So have you, you need to ask yourself the question, why every time? And this happens over and over again. So you can even build a model of catching those retracements, and if you imagine if you can do them over and over again, you wait for when price is going to hit a short-term high and then retrace and then enter short or long. You can build a model out of this. You're not going to be right 100%, but you can catch a lot of winning trades that way. But that's not what I want to talk about. I want to discuss Because for me, I need to understand when I'm analyzing the chart, I need to look at not only the fact that we took a short-term high or previous day high or something like that, buy side liquidity, sell side liquidity, but I need to understand why does that happen? Why does it seem that every time we tap into a short-term high or low, we reverse or we retrace, right, before going any higher or lower? Why does that happen? So think about it this way. So I already said that people, for example, let me give you an example. So you can think about it this way. So people who were assuming that price is going to continue going lower, right? They're going to place a short here. So let's say if they want to catch this move and they think that price is going to continue going lower, probably attack the liquidity resting in there, right? Where are they going to place their shorts, right? They're not going to, like, we have this tendency not to place short just somewhere random. We place it above short-term highs or lows, right? Or anything like that. So above like candles where you have like price action, right? So imagine you're going short here, right? You place your stop order here. That stop order comes, or that buy side liquidity comes in the form of a stop loss, right? That's the first type of traders. That is the very first type. There are another type of orders, right? And they're placed in the form of buy stops, and basically people who place buy stops here are betting on the fact that price is gonna break above this level and continue to go higher. So they want to enter on a breakout, right? So you're always going to have these two types of orders, and that's what ICT calls buy side liquidity. So it's going to come in the way of stop losses. And I just realized that I have that written wrong, so let me write it again. In the form of stop loss for people who want to go short, and in the form of buy stops, right? Buy stops for people who want to enter on a breakout, right? So the algorithm understands human psychology very well and understands these types of behavior because it has been trained over huge amount of data, right, to recognize this. So it's going to, right, go down and then comes back and hit those buy stops, right, or sell stops basically, right? And the question is, why does it do that? Well, think about it. If you're smart money and if you're like a big organization with a lot of money, and and that's what high frequency algorithms now are trained to do, right? You cannot just enter just like that, because if you enter with that amount of money, you can move the market against you, right? You can literally move the market against you. So in order to protect themselves against this risk, they need to have buyers or sellers. They need to have buy side liquidity or sell side liquidity so that they can pair their orders with, right? So so it's kind of like their algorithm is coded, right, to go where the liquidity is in the form of stop losses or buy stops, and those are all buy side liquidity, right, to pair their orders, right? If they are short, then they will look for orders to sell into. If they're long, they will look for liquidity to get out of their position, right? Because they cannot just do that, right? They need to have that liquidity, right? So they're just like they're. I know this is a little bit complicated, but I want you to bear with me because I think it helps understand why these kind of retracements happen. From my study and research, I think that's the most logical reason that makes sense for me. Just like they're like buy stops and stop losses for those two types of traders, there's also two types of like smart money, right? Those who are trading short term, very, very short term. So they would want to access the liquidity so that they can go short and catch these retracements, right? Or those who are looking for this liquidity to accumulate because they're long-term buyers. So they're accumulating at these retracements, right? So they're tapping into that liquidity, right? Accumulating at these retracements because they're long-term buyers, right? They're not just looking for a quick short and get out, right? And for people who may think that's ridiculous, well, if you're a person with a lot of money, right, like catching this move, right, it's pretty significant. It may not seem so if you're trading with 1 micro or 4 micros or whatever, or 4 E-minis or whatever, but if you're entering a lot of contracts and you're capturing like these small moves, and that's what high frequency algorithms are trained to do, to catch these very small moves, you know, and there are so many of them with a lot of like orders, right? That's a lot of money, right? So to recap, I want you to go into your chart, you know, and think about, you know, don't take this for granted, because I'm not like someone who has I'm gonna be honest about this, because I'm here, I'm still learning, I'm still documenting my journey, so so whatever I say is not like really hard fact, right? I'm still discovering this field, but I don't want you to take what I say for granted. Go into your chart, right, and try to observe why every time we tag into a short-term high or low, we retrace, right? And you will find that most of the time we do that because, number one, it seems that the market is conditioned to behave this way, right? To go where the liquidity is, because think about it. You want to make money, you know, big organizations making money. So it's all about liquidity. And where does it exist? That's what is going to drive price. There's nothing else other than that. Okay? So I want you to go into your chart, you know, and try to analyze this, right? And analyze yourself when you're trading. If you're going short or long, where are you placing your stop loss? Where are you doing that? And most likely, you're placing your stop loss, right, above these short-term highs or lows, right? And the algorithm, the market knows that, right? And it tends to go exactly to those levels and hit your stop loss. Have you ever like wondered, like, when your stop loss is hit, like how it just happens like very, very quickly, and it seems like it knows where your stop order is, and it goes just to that and then reverses. Look at this, right? Look at this move, right? No down close candles, straight up, you know, to this short-term high. What happens when we hit it? Retracement. There is another reason why the retracement happens, right? Like, it can happen because we have triggered the buy-side liquidity. And one more time, buy-side liquidity comes into two forms, and you can reverse it for sell-side liquidity in form of the sell stops and in form of buy stops for people who want to enter on a breakout, right, and cash this move. And those people are not wrong. It's not like those people are idiots and they don't know what to do. So imagine with me, if you have placed your buy stop here, thinking that the market is going to go up, you have captured yourself a pretty significant move. a pretty significant move. If you have maybe entered short here, right, you would have captured a significant move as well, you know. So there is not always like somebody is right or wrong. It depends on your strategy and your risk management. You know, with these ideas, if you're a breakout artist, you can make money, you can be profitable, assuming that you know what you're doing, right? And the same it goes, you know, once this buy side liquidity is hit, you know, smart money are pairing their orders, you know, with that liquidity. And again, there's two types of smart money. There's two types as well. Those who are looking for short-term profit, short-term trade, basically, right? So they're kind of like going short here and capturing moves like these, right? Going short here, capturing moves like these and getting out. And those are that are accumulating during retracements. So those are like long-term smart money, right? That are trading for the long term because they want to capture like bigger moves, like the one that we have here. Like the one we have here, exactly here. And for those type of traders, all of these retracements are opportunities to accumulate more orders, right? Accumulate more orders, right? So there's either selling going on in this area, right? Or there is buying that is going on in this area, you know? And that is necessary. That is absolutely necessary because, let me change that. Because the market is not going to move just like that. It needs sellers and buyers, you know, to be in the market, right? I hope this makes any sense, right? So like I was saying, so for those people, for smart money, long-term buyers, they're accumulating here, right? Because their strategy is to capture these big moves and tap into the bigger liquidity, the bigger buy-side liquidity that is resting here, right? So they're more long-term. They're thinking in terms of like higher time frames or larger moves, right? Not just to capture these short-term moves that are driven a lot of the time by high-frequency algorithms, right? So you have to be mindful about this, right? And you have to study, right, this behavior. And I think it's going to help you to turn it into your favor, because if you understand this, you can build a model out of this. You can really build a model out of this. All you got to do is wait for when these short-term highs and the buy side liquidity or sell side liquidity that is resting above or below, right? And enter short or long on a retracement and get out, right? And that's can be a model, you know, that can work for you, right? But above all, studying this helps you understand the key drivers of the market, right? The market does not move. And that's what ICT says all the time. And I think it comes from his observation of these kind of behaviors that happen. How in the world, if buying and selling pressure, you know, moves the market, how in the world that price since Thursday, and look at what happens on Thursday. We manipulated here. We took the buy side liquidity from the previous day high, right? And we came all the way here since Thursday, have been driving down until we got into Tuesday. And as soon as we hit it, what happens? We reverse. This is called, in the world of ICT, smart money reversal. And we reversed. Why? Is this buying selling pressure? Impossible. It's impossible. What happened here, if you understand liquidity, and how the market moves to harvest liquidity is that smart money has tapped into the sell side liquidity here, right? So remember, smart money cannot just enter like that, right? They're going to move the market against them. They need to pair their orders, right, with willing buyers and sellers. So they tapped into this liquidity here, right? Once that happened, they drove price here, and that was their exit. So you can see again how when we tapped into this buy side liquidity from Thursday, we retraced, until the end of the afternoon session. So I think that is a very, 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 very important information to know, and go into your chart and you will see it over and over and over again. And it helps remove first the idea that buying and selling pressure moves the market, because that's a myth. It helps you see how this market is rigged, right? And how it's all about liquidity and where does it rest. And that's what is always going to be the driver of price. Nothing else. Nothing else will do that, right? So go into your chart and study this. And I want to close this by showing you my execution for today, right? It wasn't a big execution, because I was working all the day and I didn't have time to trade. But I was like, when I find the time, I was monitoring what was happening. And when I finished work, Moroccan time around 6:30, right? So I was able to participate in the last 2 hours before the close of the market, and I took this trade, right? And I want you to, for some reason, I cannot show it to you here, because trade of it when the day is over does not show you is execution for some reason. I think it's because of TradingView. I'm not maybe a premium member in TradingView. That's why as soon as the trading day is over, it doesn't show me the execution. But I try to, you can see, I'm just going to zoom in here, and you can see how the levels that I highlighted here in orange, let me just show them to you, are my trades, and you can see how they match. So for those of you who might be doubting maybe this trade or something like that, you can see how they match. So my entry was at 24,956, right? No, let me see. Yes, this was my entry. It was right here. Let me just move the price here so that we can see both. Okay, great. So this was my entry right here. This was my my entry. So that's 24,956.75. That's the same thing here. 24,956.75. That was my entry. Was right here. It was right about here. So I just waited for this retracement, right, to capture this move. So this was my entry, and this was my stop loss. It wasn't very, very big. And this was my exit, right? So I was, again, I was trading with the idea of the fact that price is moving to tag into the buy side liquidity resting above here. And some of you may be saying, well, if you knew that, why didn't you stay in the trade until here? Well, I needed to go out from my family. It was Friday and we needed to go visit some members of family. So after work, I couldn't just be trading just like that. Just couldn't be trading just like that. So I had to cut my trade short and leave, right? Because they were waiting for me, right? So that's the reason I end up cutting the trade short. but it wasn't a good trade. It was, I think, a very nice move, very significant move, given the fact that I only sat down to trade for about an hour and a half just during the last 2 hours before the end of the market. And I was very happy about the fact that I could catch this move before the market was over, just, you know, to have like a successful, profitable trade, you know, on Friday. So again, you can see how you can see that my entry is here. This is my stop loss, and you can see the exit, and that's basically it's here, 84.50. That's the same price here, right? So that was my trade for the day, and it was all about understanding liquidity, understanding where is liquidity and how price is going to drive into it and set it. So that's it for today. I don't want to, like, I made this video much longer than I expected, but I hope you enjoy it. I hope you find it insightful, because I certainly learned a lot from this session about liquidity and how price moves to certain areas of where the orders are and tag into them. And well, my entry was based on that, and it was a really good trade. I could have captured all of this move, but I had to, like I said, due to family circumstances and the work obligations, I have to cut it short before the time. So that's pretty much it, guys. I hope you enjoy it. This was a great day. Enjoy your weekend, and we are going to come back again, and I will keep documenting my trade on Monday. So until then, take care.